Start with a single number, 100. That is roughly where the US dollar index is sitting this weekend, Saturday the 1st of August, 2026, and it is struggling to hold that line. For a currency that has spent years as the undisputed safe haven of choice, hovering at a round number like that, with traders openly debating whether it breaks, is not a comfortable place to be. Meanwhile, the euro has quietly staged a recovery, and the trigger was not a central bank speech or a political headline. It was an inflation number. On Friday the 31st of July, 2026, the latest Eurozone inflation figures came in firm rather than soft, and that single data point was enough to shift the tone across foreign exchange desks in Frankfurt, London, and New York. Over the next few minutes we will go through exactly what happened, why it matters, and what it means for the week directly ahead of us. To understand the euro's bounce, you have to understand what the market was positioned for. Through much of 2026, the working assumption was that Eurozone price pressures would keep cooling steadily back towards the European Central Bank's 2% target, giving the ECB room to keep trimming interest rates. Friday's data undercut that story. Inflation held firm instead of fading, and services prices in particular have proved sticky, because wages and domestic costs simply do not fall as quickly as energy prices do. In currency markets, the logic is mechanical. Firmer inflation means fewer expected rate cuts, fewer expected cuts means a higher path for euro interest rates, and a higher path for rates makes holding euros more attractive relative to holding dollars. That is the interest rate differential at work, and it is the single most reliable driver of major currency pairs over a horizon of weeks and months. The other half of this story sits in Washington. The Federal Reserve has just delivered what analysts are describing as a hawkish split, meaning policymakers are visibly divided over how quickly to keep easing policy. Dissent inside the Federal Open Market Committee is not unusual on its own, but a genuine split matters because it removes the certainty that traders price into forward curves. When the committee speaks with one voice, markets can position confidently. When it fractures, every subsequent data release carries more weight, because nobody knows which faction the next number will strengthen. That uncertainty has left the dollar unusually vulnerable to disappointment. It also explains why the greenback has not been rescued by rising US yields in the way textbook models would suggest. The market is no longer simply asking how high American rates go. It is asking whether the Fed itself is confident about the answer, and right now it plainly is not. There is a third force pressing on the dollar, and it comes from Japan. The dollar index has been struggling near 100 following suspected intervention by Japanese authorities, a move designed to defend the yen after a prolonged period of weakness. Intervention works by selling dollars and buying yen in size, and because the yen carries a meaningful weight inside the dollar index, that selling drags the whole index lower. The knock-on effect for the euro is indirect but real. A softer dollar across the board lifts the euro even when nothing specific has changed in Europe. It also introduces a new risk that traders must respect, because official intervention is deliberately unpredictable and can arrive without warning. Anyone running a short yen or long dollar position now has to price in the possibility that a government desk, rather than the market, decides the next move. Look across to the metals market and you can see the same tension playing out. Gold has slid as US Treasury yields surge, leaving the $4,100 level out of reach for now. The mechanism is straightforward: gold pays no income, so when the yield on government bonds rises, the opportunity cost of holding bullion rises with it, and money rotates out. What makes the current picture unusual is the disconnect. Rising US yields would normally pull the dollar higher alongside them. Instead, the dollar is soft, gold is weak, and the euro is firming, which tells you that yields are climbing for uncomfortable reasons, namely supply, deficits, and inflation persistence, rather than a genuine improvement in growth expectations. For anyone holding gold as a hedge, that distinction is critical. This is not a risk on rally lifting all assets. It is a repricing of the cost of money itself. So how does any of this reach ordinary life? Start with the good news. A stronger euro makes imports cheaper for the Eurozone, and because oil, gas, and most commodities are priced in dollars, a firmer single currency softens energy bills and shipping costs. That is a genuine tailwind for the cost of living across the bloc. The flip side hits exporters. German carmakers, French luxury groups and industrial manufacturers all become less competitive abroad when the euro appreciates, because their goods cost more in dollar terms. Meanwhile, firm inflation means borrowers hoping for cheaper mortgages should temper their expectations, since the ECB now has less room to cut. Savers, by contrast, keep earning meaningful returns on deposits for longer. And for anyone in Britain or elsewhere planning a trip to the continent, a stronger euro simply means your holiday money buys less than it did a fortnight ago. Now to the week ahead, and the calendar is unusually clean. With the Fed openly divided, the American labor market takes center stage, and the employment figures due in the coming days become the single most important input for both currencies. The logic is simple. A strong jobs report strengthens the hawkish camp inside the Fed, pushes rate cut expectations further out, and gives the dollar a genuine reason to reclaim the 100 handle. A weak report does the opposite, reinforcing the case for easing and potentially sending the dollar index decisively through that level, with the euro the most obvious beneficiary. Watch the wage growth component closely rather than just the headline hiring number, because wages feed directly into services inflation on both sides of the Atlantic. Expect volatility rather than a clean trend, and treat the 100 level on the dollar index as the line that defines the next phase. Here's what to hold on to. The euro's recovery this week was not driven by European strength so much as by two things happening at once: inflation in the Eurozone refusing to fall on schedule, and the dollar losing support from a divided Federal Reserve and suspected Japanese intervention. That combination is fragile, and it can reverse quickly on a single strong American jobs print. The deeper signal is that the era of confident, one-directional central bank easing is over. Policymakers in Frankfurt and Washington are both navigating sticky prices with far less certainty than they had a year ago, and markets are repricing that uncertainty asset by asset, from currencies to bonds to gold below $4,100. Keep your eye on the interest rate differential and on the 100 level. Those two things will tell you more about the euro's direction than any headline will.